Taxation in the case of debt-oriented funds has gone up considerably after the budget 2023. Earlier it used to be quite friendly, but now it is not so. In this video, we will discuss about the taxation of the fixed deposits, debt-oriented funds and equity-oriented funds. We will also see how much is the risk associated with these three products and what are the returns that you can expect from them in the year 2023. And we will also see what is the best option for you to invest in the current year. Hello everyone, welcome to KCC channel. I am CS Sandeep Bhatnagar. Taxation in the case of debt-oriented funds used to be quite friendly in the sense that when you invested in them for more than 3 years, you could index your cost of purchase. At the same time, the tax rate was also flat at the rate of 20%. Let's try to understand this with the help of an example. Supposing you invested 1 lakh rupees 5 years ago in a debt-oriented fund and now you are encashing it, you are redeeming it at the price of 2 lakh rupees. Your cost of purchase is 1 lakh rupees. You apply the cost inflation index. For instance, it could be now 1,50,000 rupees. So 2 lakh minus 1,50,000 rupees, your net gain, taxable gain is 50,000 rupees. You pay tax at the rate of 20%. That is 10,000 rupees you pay tax. Whereas now what has changed? Now whatever gain that you have on the debt oriented fund, you simply have to include that amount in your taxable income and pay tax according to your slab rate. In our case, the gain is 1 lakh rupees. You include that in your taxable income, and if you are in a slab rate of 30%, you pay tax of 30,000 rupees. Earlier, the tax according to the old method was 10,000 rupees and now it is 30,000 rupees, which is 3 times the amount that you had to pay earlier. So this is a massive change that has happened in the taxation of debt oriented fund, which has made it very less attractive now. Now how does the taxation take place in the case of fixed deposits? Whatever interest you earn on a fixed deposit, you include that in your taxable income and you pay tax according to your slab rate. In the case of equity oriented fund, the taxation is still very tax friendly. If you invest for a period of less than 1 year, you pay tax on the gain amount 15%. When you invest in an equity oriented fund for a period of more than 1 year, then you pay on the gain amount a tax at the rate of 10%. So the taxation is quite attractive in the case of equity oriented funds. Now let us see how the returns you can expect, how much returns you can expect in these three instruments. Debt oriented funds, which are normally available, give a return of around 7%. There could be funds which could be giving you more returns, but they are less attractive in the sense that they are more risky. Therefore, the average return that you can expect from the debt mutual fund could be 7%. But you have to factor in the tax rate also. So the tax on 7% would work out to be, if your slab rate is 30%, it could work out to be around 2%. So net rate of return that you can expect from the debt mutual fund could be around 5%. Now let us see what is the return that you can expect from the fixed deposits. Now the interest rates are quite high and almost all the banks are offering a rate of interest of about 7%, and when you factor in the tax in it, you get a net rate of return of around 5%, which is quite comparable to the debt oriented fund. Now the returns from the equity oriented funds could be in the range of 11%. There could be equity funds which could offer a higher return, but on an average you can take that as 11%. Now when you apply the tax rate on that, which is only 10%, that could work out to be a net rate of return of about 10%. So now you see the difference whereas the mutual funds in the debt category and the fixed deposits offer a net rate of return of about 5%, and the equity oriented funds offer a return of about 10%, which is double the rate that we are having in the other two instruments. Now, next aspect to be considered here is that what are the risks involved. In the case of fixed deposits, the risks involved is very low because there is very less chances of a bank going bust. Whereas in the case of debt oriented funds, the risk could be low to moderate because in the case of debt mutual funds, the investments in is done in the corporate bonds also, so the returns are slightly higher, but the risk is also slightly higher. However, in the case of equity oriented funds, the risk is high. As the saying goes, higher the risk, higher the return. Therefore, in the case of equity oriented funds, the risks are high. Now, what could be best for you in this scenario? So now, if you are a conservative investor, you should invest in fixed deposits or debt oriented funds. But when you consider the debt oriented funds with the fixed deposits, you find that the fixed deposits are more attractive because the risk associated with them is low. But if you are an aggressive investor, you could consider investing in the equity oriented funds in order to maximize your return. Another thing to be considered is the time horizon. If your time horizon is less, if you want to invest for a period of 1 year, 2 years, or 3 years, you should consider investing in fixed deposits or debt oriented fund. But if your time horizon is more than 4 years, 5 years rather, then you can consider investing in the equity oriented fund. Therefore, these are the factors that you should consider before investing in these three products. However, nowadays we are seeing for the short term scenario, for short period of 1 year, 2 year, 3 years, people are investing more in the fixed deposits rather than the debt oriented funds because of the fact that the taxation has gone against the debt oriented funds. So this is the comparison between these three products, and I hope that you enjoyed this video, you find this interesting and informative, and if you find this interesting, then please give it a thumbs up and subscribe to our channel, click the alert notification and share the video as much as possible. Thanks for watching. Goodbye for now.